Are you a beginner? Then you're on the right track. This episode, we will explain Bitcoin trading. I know you are very excited. Let's get started! What are the 5 common mistakes of 90% of Bitcoin traders? How do I even start trading? How do I read all of these confusing price charts that I see online? Well, stick around. We'll answer these questions and more. If there's one thing we get asked a lot here is how to trade Bitcoins. So we decided to dedicate this episode teaching you what Bitcoin trading is all about. This lesson will be longer than usual, but I assure you, it will be worth your time. We're going to cover 4 major topics: the definition of Bitcoin trading, the main terms you encounter while trading on an exchange, the main terms you encounter when trading on exchanges, a very short intro into reading price graphs, and finally, we'll go over some common trading mistakes. Let's get started! So, what is Bitcoin trading and how is it different from investing in Bitcoin? Well, when people invest in Bitcoin, it usually means that they're buying Bitcoin for the long term. In other words, they believe that the price will ultimately rise, regardless of the ups and downs that occur along the way. Usually, people invest in Bitcoin because they believe in the technology, ideology, or team behind the currency. Bitcoin investors tend to hold the currency long term. Hold is a popular term in the Bitcoin community that was actually born out of typo of the word hold in an old 2013 post in the Bitcoin Talk forum. So while Bitcoin investors buy and hold for the long term, Bitcoin traders buy and sell Bitcoin in the short term. Whenever they think a profit can be made, traders view Bitcoin as an instrument for making profits. Sometimes, they don't really care about the technology or the ideology behind the product they're trading. Of course, people can still trade Bitcoin if they do care about it, and many people out there invest and trade at the same time. But why are so many people looking to trade cryptocurrency, especially Bitcoin, all of a sudden? Here are a few reasons. First, Bitcoin is very volatile. In other words, you can make a nice amount of profit if you manage to correctly anticipate the market. Second, unlike traditional markets, Bitcoin trading is open 24/7. Most traditional markets such as stocks and commodities have an opening and closing time. With Bitcoin, you can buy and sell whenever you please. Finally, Bitcoin's unregulated landscape makes it relatively easy to start trading without the need of long identity verification process. But all traders are not the same, and there are different types of trading methods. For example, day trading involves conducting multiple trades throughout the day and trying to profit from short-term price movements. Day traders spend a lot of time staring at computer screens at the end of the day, then usually just close all of their trades. Scalping is a day trading strategy that a lot of people are talking about. Scalping attempts to make a substantial profits on small price changes, and is often referred to as picking up pennies in front of a steamroller. Scalping focuses on extremely short-term trading, and it's based on the idea that makes small profits repeatedly, limits risk, and creates advantages for traders. Scalpers can make dozens or even hundreds of trades in one day. Meanwhile, swing traders try to take advantages of the natural swing of the price cycles. Swing traders try to spot the beginning of a specific price movement and enter the trade. Then they hold on until the movement dies out and take the profit. They try to see the big picture without constantly monitoring their computer screens. Swing traders can open a trading position and hold it open for weeks or months until they reach the desired results. So now that you know what trading is, how is it actually accomplished? How can someone predict what Bitcoin will do? The short term is that no one can really predict what will happen to the price of Bitcoin. However, some traders have identified certain patterns, methods, and rules that allow them to make profit in the long run. People follow 2 main methodologies when they trade Bitcoin, or anything else for the matter: fundamental analysis and technical analysis. Fundamental analysis looks at the bigger picture. In Bitcoin's case, fundamental analysis evaluates Bitcoin's industry, news about the currency, technical developments of Bitcoin such as the Lightning Network, regulations around the world, and any other news or issues that can affect the success of Bitcoin. This methodology looks at Bitcoin's value as a technology regardless of the current price and at outside forces in order to determine what will happen to the price. For example, if China suddenly decides to ban Bitcoin, this analysis will predict when the price will probably drop. Technical analysis try to predict the prices by studying market statistics such as past prices movement and trading volumes. It tries to identify patterns and trends in the price, which may suggest what will happen to the price in the future. Technical analysis assumes the following: regardless of what's currently happening in the world, price movement speaks for themselves and tells some sort of story story that helps you predict what will happen next. So which methodology is better? Well, like I said in the beginning, no one can accurately predict the future. However, a healthy mix of both methodologies will probably yield the best results. Now let's continue to break down some of the confusing terms and statistics you'll encounter on most of the exchanges. Bitcoin exchanges are an online site where buyers and sellers are automatically matched. An exchange is different than a Bitcoin company that sells you Bitcoin directly, such as CoinMama. This type of company will usually charge a higher fee. An exchange is also different from a marketplace such as local Bitcoins, where buyers and sellers directly communicate with each other in order to complete a trade. The complete list of buy-in orders and sell orders are listed in the market's order book, which can be viewed on the exchange. The buy orders are called bids, since people are bidding on the prices to buy Bitcoin. However, the sell orders are called ask, since they show the asking price that the seller requests. Whenever people refer to Bitcoin's price, they're actually referring to the price of the last trade conducted on a specific exchange. This important distinction occurs because there is no single global Bitcoin price that everyone follows, and sometimes Bitcoin's price in other countries can be different from Bitcoin's price in the US. Since the major exchanges in these countries include different trades, aside from the price, you will also sometimes see the terms high and low. These terms refer to the highest and lowest price in the last 24 hours. Another important term is volume. It stands for the number of overall Bitcoins that have been traded in a given time frame. Significant trends are usually accompanied by a large trading volume, while weak trends are accompanied by low volumes. A healthy upward trend is accompanied by a high volumes when the price rises and low volumes when the price declines. If you are witnessing a sudden change of direction in the price, experts recommend checking how significant the trading volume is in order to determine if it's just a minor correction or the beginning of an opposite trend. So now you know most of the terms you encounter on the average exchange. It's time for us to move on and go over the types of orders that you can place on the exchange. There are three types of orders. A market or instant order refers to an order that will instantly fulfilled at any possible price. So if you put a market order to buy 5 Bitcoins, you will find the cheapest sellers possible until it accumulates enough sellers to hand over 5 Bitcoins. In other words, you might end up buying 3 Bitcoins at one price and the other 2 at a higher price. In a market order, you don't stop buying Bitcoins until the amount requested is reached. With market orders, you may end up paying more than you intended, so be careful. Meanwhile, with a limit order, you only buy or sell Bitcoin at a specific price that you decide on. In other words, the order may not be entirely fulfilled, since there won't be enough buyers or sellers to meet your requirements. Let's say that you place a limit order to buy 5 Bitcoins at $10,000 per coin. Then you could end up only buying 4 Bitcoins because there were no other sellers willing to sell you the final Bitcoin at $10,000. The remaining order for 1 Bitcoin will stay there until the price hits $10,000 again, and the order will then be fulfilled. A stop loss order lets you set a specific price that you want to sell at in the future in case the price dramatically drops. This type of order is useful for minimizing losses. It's basically an order that tells the exchange of the following: if the price drops by a certain percentage or to a certain level, I will sell my Bitcoins at the present price, so I will lose as little money as possible. A stop loss order acts like a market order. In other words, once the price stops is reached, the market will start selling your coins at any price until the order is fulfilled. Other terms that you may encounter when trading on exchange are market fees and taker fees. Personally, I will find this model to be one of the most confusing ones, but let's try to break it down. Exchange wants to encourage people to trade. In other words, they want to make a market. Therefore, whenever you create an order that can't be matched by any existing buyer or seller, you're basically a market maker and you will usually have your lowest fees. Meanwhile, a market taker places orders that are instantly fulfilled. Since there was already a market maker in place to match the requests, takers remove business from the exchange, so they usually have higher fees than makers who add orders to the exchange order book. For example, perhaps you put a limit order in to buy 1 Bitcoin at $10,000 at most, but the lowest seller is only willing to sell at $11,000. Then you just created a new market for sellers who want to sell at $10,000. So whenever you place a buy order below the market price or a sell order above the market price, you become a market maker. Using that same example, perhaps you place a limit order to buy 1 Bitcoin at $12,000 at most, and the lowest seller is selling 1 Bitcoin at $11,000, then your order will be instantly fulfilled. You'll be making orders from the exchange order book, so you're considered a market taker. Now that you're familiar with the main Bitcoin exchange terms, let me give you a short intro into reading price graphs. These are Japanese candlesticks. They are based on an ancient Japanese method of technical analysis used in trading rice in 1600s. Each candle shows the opening, lowest, highest, and closing price of the given time period. That's why you sometimes see people refer to the candles as OHLC, open, high, low, and close. Depending on whenever the candle is green or red, you can tell if the closing price of the time frame was higher or lower than the opening price. If a candle is green, it means that the opening price was lower than the closing price, so the price went up overall during this time frame. On the other hand, if the candle is red, it means that the opening price was higher than the closing price, so the price went down. In the image that you can see, the opening price in the wide bottom part of the candle, the closing price in the wide top part of the candle, and the highest and lowest trades within this time frame on both ends of the candle. When we're in a bull market, most of the candlesticks will usually be green. And if it's a bear market, most of the candlesticks will be red. So what are bull or bear markets? These markets are named after these animals because of the way they attack their opponents. A bull thrusts his horn up into the air while a bear swipes his paws downward. So these animals are metaphors for the movement of the market. If the trend is up, it's a bull market, but if the trend is down, it's a bear market. Here's another important feature to be familiar with while analyzing graphs: resistance levels. Occasionally, Bitcoin's prices seem to hit a virtual ceiling, and you can't break through it for a long time. That's a resistance level. So if a Bitcoin fails to break $10,000, the resistance level is $10,000. Usually at the resistance level, you will see a lot of sell orders, and that's why the price fails to break through that specific point. Meanwhile, there's also a support level. In other words, there's a price that Bitcoin might not go below. Support levels act as a floor by preventing the price of an asset from being pushed down. A support level will be accompanied by a lot of buy orders set at the level's price. The high demand of a buyer at the support level cushions the downtrend. Historically, the more frequently the price has been unable to move beyond the support or resistance level, the stronger these levels are considered. Here's a common characteristics of both support and resistance levels. They're usually set at a round number, since most inexperienced traders tend to buy or sell when the price is at whole number. So usually you see a lot of buy or sell orders around prices like $10,000 rather than a price like $10,034. Because so many orders are placed at the same level, these round numbers tend to act as a strong price barriers. Psychologically also create support and resistance levels. For example, until 2017, it seems expensive to pay $1,000 per Bitcoin. So there was a strong resistance levels at $1,000. But once that level was breached, a new psychological resistance level was created, $10,000. Congratulations! You now know the basics of Bitcoin trading. However, there's still a lot more to it. Since we can possibly go over everything in one lesson, I want to direct you to additional resources that will take you to the next level of trading. Before we end this video, let's go over the most common mistakes that people make when they start trading. In the hopes that you'll be able to avoid them, the biggest mistake you can make is to risk more money than you can afford to lose. Take a look at the amount you feel comfortable with. Here's the worst case scenario. You end up losing it all. If you find yourself trading above that amount, stop. You're doing it wrong. Trading is a very risky business, and if you invest more money than you're comfortable with, it will affect how you trade, and it may cause you to make bad decisions. Mostly, you may end up losing a portion of your money that you can't do without. Another mistake that people make when starting out with trading is not having an action plan that's clear enough. In other words, they don't know why they're entering a specific trade, and more importantly, when they should exit that trade. So clear profit goals and stop losses should be decided before starting the trade. Moving on, never leave money on an exchange that you're not currently trading with. If your money is sitting on an exchange, it means that you don't have any control over it. If the exchange gets hacked, goes offline, or goes out of business, you might end up losing that money. Whenever you have money that isn't needed in the short term for trading on the exchange, make sure to move it into your own Bitcoin wallet or bank account for safekeeping. Two basic emotions tend to control the actions of many traders: fear and greed. Fear can feed in the form of prematurely closing your trade because you read a disturbing news article, heard a few rumors from your friend, or get scared by a sudden dip in the price that will soon be corrected. The other major emotion, greed, is actually based on fear. The fear of missing out when you hear people telling you about the next big thing or when the market prices rise sharply. You don't want to miss out on all the action, so you may get into trade too soon or even delay closing an open trade. Remember that in most cases, our emotions rule us. So never say this won't happen to me. Be aware of your natural tendencies towards fear and greed, and make sure to stick to the plan that was laid before you start the trade. Let's wrap things up. Regardless of whenever or not you made a successful trade, there's always a lesson to be learned. No one manages to only make profitable trades, and no one gets to the point of making money without losing some money on the way. The important thing isn't necessarily whenever or not you made money. Rather, it's whenever or not you managed to gain some new insights into how to trade better the next time. We spent a great deal of time today talking about Bitcoin trading, but I have to warn you, the majority of people who start trading stop after a short while because they don't successfully make any money. Here's my opinion. If you want to be successful at trading, you have to put in a significant amount of time and money to acquire the relevant skills. Just like any other venture, if you want to get into trading just to make a quick buck, then perhaps it's better just to avoid trading altogether. There's no such thing as quick, easy money without a risk or downside at the other end. However, if you're committed to learning how to become a professional Bitcoin trader, take a look at the How Our Resources section below. Then you can get the best possible tools and continue your education. You may still have some questions. If so, leave them in the comment section below, and if you're watching this video on YouTube and enjoy what you've seen, don't forget to hit the like button, then make sure to subscribe for notifications for faster updates. See you next time!